One of the reasons why people do business is to make profit. So in this video, I'm going to discuss how a sole trader calculates his profit. So to calculate profit, there is a particular statement, a calculation made. We call it statement of profit and loss. This is part of the financial statements. When I say financial statements, I'm talking about statement of comprehensive income, statement of financial position, statement of cash flows, statement showing changes in retained earnings, and notes to the accounts. But these 5 components of financial statements only apply for a public limited company. In this video, I'm going to discuss a sole trader, a business owned and controlled by a single individual. So if you are a single individual, you are a sole trader. If you are in business, how would you calculate profit? So I'm going to prepare a statement which we call statement of comprehensive income or statement of profit and loss or simple profit and loss account. So the purpose is to calculate profit. I would highly recommend that you watch my videos on Basic Accounting 1 and Basic Accounting 2, where I've given you all the details of the technical terms, what is profit, what is revenue, what is income, cost, expenses. So I highly recommend that you watch these 2 videos in order to get the prerequisite understanding. So now let's jump into making an income statement. Ideally, we start off with sales. Now I'm just assuming a number here, let's say 800,000. Less sales returns. You can also call it return inwards. 20,000. I'm just assuming figures. You will have net sales, which is 780,000. Now what is meant by all this? Obviously, if you're a sole trader, let's suppose you're selling calculators, you're selling computers, you're selling clothing items. So this sales shows what is the amount you have collected by selling goods to your customers. For example, let's say you have sold 80,000 units and your selling price is $10. So that's how you got 800,000. This sales is one example of revenue. Another word for revenue is income. The incoming cash. You sold goods, you got how much? 800,000. In most of the countries, there is a policy when you sell goods to your customer, there is a provision that if they don't like the goods, they can return within 15 days. So it is very normal that customers do return goods back to us which we have sold them. Okay, so when you sell, expect there will be some returns. So what were the returns? Returns were worth 20,000. So what is your net sales? 780,000. Now this net sales, you can call it as your income or revenue. This is the amount of your sales after returns. So after net sales, you have to find cost of goods sold, which means you sold goods for 780,000. How much it cost the business? So first of all, you start off with opening stock. I'm assuming it to be 30,000. Add purchases. Let's say 400,000. Add transportation. Transportation in or inwards, the full word, you can also have carriage or freight. Say 10,000. So when you add all this, it gives you 440,000. Now what is happening here is, when your year began, you had stock worth 30,000. Say calculators worth 30,000. This was not enough for the whole year, you purchased more. 400,000 worth of calculators, you purchased more. Obviously, when you purchase, you must have bought it in a van or a motor vehicle or a taxi or a truck. So that is what known as transportation in. Transportation in is the amount you pay when you buy your stock, your goods, to bring them from the place of purchase to your warehouse. Okay? So these 3 words, transportation, freight and carriage, is the same, but the modes are different. If you are paying for a motor vehicle or motor lorry or some type of car or vehicle, we call it transportation. If the goods have come through air or sea, through aeroplane or a ship, we use the word freight. That could be air freight or sea freight. If it came through railways, then normally we use the word carriage. So the mode of transportation is different, but transportation inward, carriage inward, or freight inward means you have paid for transportation when you purchase the goods. So what is the total amount? 440,000. Obviously from this, maybe some of the goods which you have purchased from your supplier, you don't like it, you may return. So we call it purchase return. Purchase return is also known as return outwards. RET is a short form for return. OUT means outward or purchase returns. So I'm assuming it to be 15,000, and then closing stock. Closing stock. Say 25,000. So these are to be subtracted. 440 and this adds up to 40. This will be your cost of goods sold. 440 minus 40 will give you 400,000. Now, this part requires some explanation. In order to make life easy, understand when you're calculating cost of goods sold, you have to add 3 items. Opening stock, then purchases, and any freight transportation paid on purchase. Okay, so you have opening stock, purchases, and any freight transportation paid. You add them up. So the total cost of stock which you have, including the opening stock, the additional purchases, and the transportation paid on it, is 440,000. So from 440, if I minus 15,000, some goods I return. So 440 minus 15 will give you 425. Now from 425 worth of stock, you are left with 25,000 stock at the end. So what happened to the rest? They have been sold. For example, if I tell you I have 10 pence, total 10 pence, and at the end of the year I am left with 2 pence. So what happened to the rest? They have been sold. So from total purchases, when you minus purchase returns and closing stock, what you're left with is the cost of goods which have been sold. So cost of goods sold is to be subtracted. This is, let's say, your cost, which means the calculators which cost you 400,000, you sold them to customer for 780. So the difference between cost and income, or in other words, the sales and your cost of goods sold, is known as gross profit. So this is 380,000. For your understanding, there are 2 things I know. Primarily, I know 2 things. One is a little bit of accounting and finance. The other is martial arts. So I'm just giving an example. If this is my business, from morning till evening, let's say 9 to 5, I have a business of selling calculators. So calculators which cost me 400,000, I was able to sell it for 780,000. I made a gross profit of 380,000. But I do have some other sources of income. In the evening, maybe I teach martial arts, kickboxing. What if I am a lawyer? In the evening, I have some clients, I charge fees, consultancy. What if I am a real estate agent? Okay, in the morning, I sell calculators. I have a business of selling calculators. In the evening, yes, I do some real estate business and I get some commission. Okay, so there is a possibility a sole trader may have one main business, that is this one, buying and selling calculators, and then they may have some side business. For that, this gross profit is earned by buying and selling calculators. After this, you may write add other incomes. So the very first income you should be thinking about is something known as discount received. Or you can also call it purchase discount. Now, discount received, obviously when we buy in bulk, we do get some discounts. When we pay before time, we do get some discount. So any discount which we are receiving from our supplier is known as an income. It is treated as an income. So discount received is treated as an income. So it could be discount received. I'm giving you other type of income. Okay, this is by default. You have to check in the question if discount received is there. Otherwise, normal income is known as fee income. As I told you, I teach martial arts, I charge fee. So there could be fee income. Another source of income could be interest. Okay, it could be rental income. It could be commissions. So apart from buying and selling calculators, I may have some other source of income. It could be rental income, interest income, fee income, commission income, so on and so forth. So I'm assuming all these other incomes adds up to, let's say, 100,000. So 380,000 gross profit from selling calculators. Other sources of income is 100,000. I have total 480,000. And then we are talking about operating expenses. Every business have some sort of expenses. Now, when I use the term operating expenses, I am talking about expenses which are necessary to carry on business. So among operating expenses, the first thing you should look for is sales discount. It is also known as discount allowed. If we are giving discount to somebody, that means we are losing, we are not earning, that person is earning. So when we sell goods, customer asks for some discount, they do some negotiation. If we give some discount, basically the discount when we give at the time of selling is known as sale discount, and it is treated as a selling expense. So you look for sales discount, and then we have very common expenses like salaries, rent, insurance, utilities, like payment for electricity, water, gas and all that. Okay, then we are talking about some repair and maintenance. Okay, some taxes. There is something known as bad debt expense, bad debts, and depreciation. I think most of the expenses are self-explanatory apart from bad debts and depreciation. Bad debt expense is also a selling expense. What is bad debts? Bad debt is the money which you are unable to receive and collect from your customers. Sometimes you sell on credit, you sell and you tell your customer you can pay later. So let's say you sold goods on credit for 50,000. Your customer said that they'll pay you after 1 month. After 1 month, they're only paying you 49,000 and they're not paying you 1,000. You tried your level best. So 1,000 which you were unable to collect and recover from your customer is considered bad debts, and again, it's a selling expense. Depreciation expense is again an operating expense. Why? For example, in order to buy and sell calculators, you used your furniture, your computer, your machineries, and obviously at the beginning of the year they were new. During the year you used them to generate revenue and they have become old. So let's say you had a computer which had a value of, let's say, $2,000 at the beginning of the year. Because you used it in your business to generate revenue, at the end of the year its value is just $1,500. So from 200,000 to 1,500, the fall in the value of non-current asset is generally known as depreciation. So we have used non-current assets to generate income, and the value of non-current assets going down is basically depreciation in a layman's word. So I'm adding all my expenses. I'm assuming my expenses to be 280,000. So from 480, when I minus 280,000, I'm getting 200,000. This is my net profit. You can call it net profit, you can call it net income, it's up to you. So a brief recap of income statement, or you can call it statement of profit and loss. If you want, you can divide this income statement into section. I would say the very first section is to calculate net sales. How? Sales minus sales return is net sales. This is the first part. Whenever you are asked to prepare an income statement, a statement of comprehensive income, you can call it profit and loss account, what is the first step? To calculate net sales. How? Sales minus sales return, you will get net sales. The second step, which is the lengthiest, is calculating your cost of goods sold. This is your second step. But I've made life easy for you. In order to calculate cost of goods sold, you have to add three items: opening stock, purchases, and freight inwards, transportation inwards. You can call it carriage inwards. So three items you are adding. Can you see this? 1, 2, 3. Opening stock, purchases of new goods, and any transportation paid. Once you add them, after that you minus two items from here. One is purchase return, which is also known as return outwards. The other is closing stock. So in order to calculate cost of goods sold, you add three items: opening stock, purchases, and freight inwards, and you minus purchase return and closing stock. Boom, you'll get your cost of goods sold, which is 400,000. Once you get your cost of goods sold, you got to subtract it from net sales. 780 minus 400,000 is your gross profit. Now I want you to pay attention here. Technically, gross profit is the difference between selling price and cost price. So when I say sales, I'm not talking about selling price of one unit. I'm talking about all the units. Look, 80,000 into selling price of one unit. Selling price of one unit is 10. I'm selling 80,000 units. So if I talk about one unit, it is 10 selling price. But for all the units, I call it sales or income. So when I compare these two, it makes sense. Something which cost me 400,000, I was able to sell it for 780. So the amount I made over and above my cost is 380,000, which is known as gross profit. So first step, net sales. Second step, cost of goods sold. Now, third step is you have to add your other sources of income. Other incomes. Discount received, fee income, interest income, rental income, commission income, whatever. If you have it, right. If you don't have it, you can put 0 here. And the last step is you got to add all your expenses. Always begin with sale discount or discount allowed. This is the discount when you're selling, you give to your customers. All right. Then we are talking about salaries paid to staff, rent of the office, insurance, electricity, water, gas bills, repair and maintenance, taxes if any, bad debt expense, the amount which you are unable to collect from your customers, and depreciation is the cost of using your non-current assets in order to generate revenue. So when I added all my expenses, I'm assuming they add up to 280,000. So from 480, you minus 280,000, you get net profit. Now here you need to be very careful. Look at the amount of your total income, that is after gross profit when you added your other income, is 480,000, and your expenses are just 280. So your expenses are less, your gross profit, total gross profit is more. That's why you're making a profit. What if your expenses are not 280 but 580? So your expenses are more than this amount. In that case, you'll end up making a net loss. So once you have calculated profit or loss, the next step is to prepare statement of financial position, which is also known as balance sheet. Now, balance sheet is very simple. On one hand, you have all your assets, whether they be non-current or current. On the other hand, you have equities. When I say equities, I'm talking about capital and liabilities. So let's see how a simple statement of financial position is made. Just make a T. Okay, this is statement of financial position, or you can call it balance sheet. It's up to you. But the correct term is statement of financial position. On this side, you have all your assets. If you have seen my previous videos on basic accounting, assets, there are two types of assets. One is known as non-current assets. Okay, non-current assets are those assets which we can utilize in our business for more than 1 year. So examples of non-current assets are like, let's say, land. We are talking about building. We are talking about plant and machinery. We are talking about motor vehicle. We are talking about furniture. We are talking about equipment. All right. So land is an asset which does not depreciate. So I'm taking its value to be, let's say, 100,000. All the other items are on net book value. When I say net book value, means their historical cost minus accumulated depreciation. When I say accumulated depreciation, I mean total depreciation. For example, if I talk about building, its historical cost, let's say 5 years back, we purchased it for 500,000. And in 5 years, the total depreciation on building is 400,000. So historical cost, the amount at which we purchased for, is 500,000. Total depreciation from the date of purchase right up till the date of statement of financial position is 400,000. So cost 500,000, accumulated depreciation 400,000. When you minus, you'll get net book value, which is 100,000. Okay, you can show here cost minus accumulated depreciation, you get this. So I'm just saving time. I'm showing you how it is made. Plant and machinery, let's say 200,000. Motor vehicle, say 50,000. Furniture, 300,000. Equipment, another 300,000. So when you add all of them, you get total non-current assets. So this would be 1,050,000. Then you have current assets. When you're writing current assets, there is a particular order we follow, a particular sequence. Always start with closing stock. Closing stock is also known as merchandise inventory ending. So I'm assuming it to be, I'm taking closing stock here. It was here 25,000. Then I'm talking about account receivable. And again, I'm taking it as a net. That means your total receivable minus your bad debts. So total receivable less accumulated bad debts or provision for bad debts, I'm taking it as 175,000. Okay, this is just a guess. I'm using an amount just to show you. Then you may have your bank balances. Okay, amount in the bank is 200,000. You may have some cash balance, let's say 100,000. You may have some short-term investment. Okay, say another 100,000. So when you add all these, this is your total current assets, 600,000. So when you add these two, you will get your total assets, 1,650,000. When you're preparing a statement of financial position, what you need to do is, on one side, you take all your assets, whether they are non-current or current. Care is to be taken when you're talking about non-current assets. Make sure you take their historical cost minus accumulated depreciation, and then that net book value is to be shown here. You can show the working. I don't have space. Otherwise, I would have written something like this. Look, for example, I'm talking about building. I write building like this. 500,000 is the cost of building less accumulated depreciation, which is 400,000. Okay, so the net book value will come here as 100,000. So this 100,000 I've taken here. Okay, so for all you have to show historical cost less accumulated depreciation, net book value. Net book value is then totaled for all the non-current assets. We get total non-current assets. Then we had current assets, closing stock, receivables, bank balance, cash balance, any short-term investments. You add all of them, you get 600,000. Now you add your non-current assets and your current assets in order to arrive at total assets. On the other side of the balance sheet, we have something known as equities. This equities means liabilities plus capital. So let's start off with capital because we're talking about sole trader. So I'm starting with capital at start. Capital at start means the initial investment. When he started the business, how much did he invest in the beginning? I'm assuming it to be 800,000. Then we are talking about add net profit. Now when I say net profit, this is the amount I'm talking about. So if you don't prepare your income statement, you will not get net profit, and you need net profit in order to prepare your statement of financial position. So I'm writing this with red. It is 200,000. So your net profit is 200,000. So when you add these two, you get 1 million. After this, we are talking about less drawings. I'm just taking it to be 50,000. So you'll get 950,000. This is normally called capital at end. So just to give you a recap, what is drawings? Drawing is the amount of cash or equivalent the owner withdraws from business for personal use. Let's say if I have a business, okay, if I pay rent of the office, that is known as offered rent. If I pay salaries to my staff, it is known as salaries expense. But what if from business cash, I am paying rent of my personal house, I am paying salaries of my domestic staff? So that is not business expense. So from business, if I take an amount to pay off something personal, that is known as drawings. So you started business with 800,000, you made a profit of 200,000, which we got from here. Total 1 million, you withdrew some amount for personal use, what you're left with? 950,000. So that's the status of your capital and the movement in capital. From the beginning, initially, beginning of the year, you invested 800,000. You made a profit, it became 1 million. Then you withdrew some money for personal use, so you're left with 950,000. After that, you may take some long-term loans. So I'm just taking it as bank loan. There are many examples, but I'm just keeping it short and simple. Bank loan, let's say another 100,000. Then you have something known as current liabilities. Current liabilities will have, let's say, accounts payable, unearned commissions, commission taken in advance and the work has not been, and the service has not been rendered. Let's say any bills payable. So I'm taking account payable as 100,000, this as 200,000, and bills payable as 300,000. So if I add, I get total current liabilities 600,000 here. When you add all this, you will get total equities 9, 10, 16, 50, 1,650,000. So why do we call it a balance sheet? Because your total assets should always come to total equities. Now total equities is the addition of your capital and your liabilities. So if you remember, the basic accounting equation was like this: assets equal liabilities plus capital. This liabilities plus capital is known as equities. And assets, when I say asset, I'm talking about total assets. When I say total assets, I'm talking about non-current assets and current assets. So if you can see here, we have non-current assets, we have current assets. When you add these two, you get total assets. When we're talking about equities, we have liabilities. See, look, this is a liability, long-term and short-term or current liability. So this is liabilities. And then we're talking about capital. This is the position of capital. So guys, this was financial statement for a sole trader. I will make one more video in which I will explain you financial statements for partnerships and for public limited companies. So if you have any queries relating to financial statements of sole trader, feel free to leave a comment. I will reply to you. If you are not yet subscribed to my channel, please subscribe. Press the bell notification button so that you get my videos on a timely basis. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.